again, grateful to have you here. Hopefully we all walk away learning a couple things and, learning some new ideas tonight. During our time, please feel free, if you need to get up and grab a drink or grab a bite, please feel free. The bathrooms are downstairs near the front entrance where you came in. They're not too close, but that's where they are, where you came in. This is our agenda. Pretty simple. We're starting with the intro, and then our guest is going to present for maybe half hour, 40 minutes, and then hopefully we'll have some engaging Q&A, and people can ask questions and hang out and talk amongst ourselves, and go from there. If you want to put your cell phone on vibrate, that'd be great. So what led to this evening tonight? A little over a year ago, I think it was May 2017, I was listening to a podcast. Now, a lot of my father, my brothers, my coworkers they get sick of that, because I'm always sending them podcasts. Listen to this, listen to this. But on this podcast episode, a guy named Dave Zook, who was our presenter this evening, it was a real estate podcast, real estate investing podcast, and he was talking about investing in ATMs, automated teller machines, ATMs. And I had never thought about that, never knew about it or anything really. And but it was an intriguing message, and so I had some time, so I looked into it and researched it, and one thing led to another, and we connected, and that's kind of how this connection started. Little did I know that a few months later, I'd be recommending to my father that we invest in a portfolio of ATMs. And we did, and so far so good. So that was the first time I'd ever heard of Dave. And then over the past year or so, I've gotten to know him pretty well. He's kind of gone from being a investment sponsor, I guess you would call him, or a fundraiser, to he's been really helpful to me in connecting me with other people and other resources, other investment opportunities, and I think, and now I consider him a friend. So, like I mentioned, I've learned a ton from Dave and from people in his circle, and we're going to talk about some of those things tonight. A little bit about Dave. He's going to tell you more about his background, but he was raised and still lives near Lancaster, Pennsylvania. He is married with 3 children. He's an avid hunter, runner, and he flies some type of airplane parachute combination deal. Dave's family owns, his parents and his brothers and siblings, they own a manufacturing business near Lancaster, Pennsylvania. They build garages, sheds, barns, chicken coops, dog kennels, and other things that you can put on a trailer and drop off in your backyard. The past 20 years or so, as well as running his family business, he started several businesses and has put together a lot of private investment opportunities for private deals. He's most well known for putting together multi-family apartment investment opportunities. Following Dave's presentation, we'll have a Q&A session. There's some orange cards on your table if you choose to write down your thoughts as he's talking and write down your question. Again, please feel free to get a drink or get a snack. And I'd like to introduce my friend Dave Zook.
All right. So when David was sharing about how he heard me on a podcast, I got a little story. My 15-year-old son was on a camping trip at church with a church group, and he woke up in the morning, and one of the counselors that was with the youth group is laying on his back, and he's got his earbuds in, and he's listening to his iPhone. And he rolls over and says, "What are you listening to? You listening to a podcast?" And you go, who listens to podcasts? And the guy and my son goes, I don't know, successful people. So just thought that was kind of funny, but yeah. So like David said, we've had many good conversations, and I've come to appreciate him. I tell you what, if I ever have a deal that I want researched, I will send it past David Sherpy. Oh my goodness, that guy knows how to research stuff. But I'm, like he said, I'm from Lancaster, Pennsylvania. I was fortunate. I was born into a family, a very entrepreneurial family, and I was an entrepreneur, I think, from the time pre-teen. I mean, I remember my dad would take me out to our manufacturing facility, and I would figure out how to nail a 2x4 to a little piece of plywood and bring it out to a customer on a Saturday, and they'd give me $1 for it. I think they thought it was cute that I was making them stuff. I'm sure they didn't want it, but I don't know. But I was an entrepreneur for about as long as I can remember. We're going to talk about David talked a little bit about ATM investing, and we're going to talk about some non-conventional investment ideas, maybe some things. I love getting in front of people and talking about maybe stimulating their thinking, stimulating people's thinking, and maybe some things that you hadn't thought about, or maybe seeing some things differently than what you had seen before, or what you had thought about these things before. I would like for this to be a very informal, very, if I'm saying something and you don't understand what I'm saying, maybe just put up your hand and ask me the question. Or one of the things I'd like to ask you is, when you think about conventional, let's just maybe go around and collect maybe 5 or 6 things that you can think of that are conventional. What does conventional mean to you? What's the conventional wisdom out there? It could be anything. It could be
stocks.
Yep. Anything else? Stocks, mutual funds, conventional thing. It could be health, could be medicine. Could be. Say it again?
Real estate.
Yeah. So we're going to be talking about some non-conventional methods tonight. I'll tell you my backstory a little bit before we kind of get into some of those. And I grew up, like I said, in an entrepreneurial family. My dad, a very successful businessman, parked his money that he made from his businesses in real estate. And it ended up actually working pretty good for him, because he was buying farms in the 80s and 90s, buying land and buying farms in the 80s and 90s. And we ended up actually taking them years later and rolling them into multifamily through 1031 exchanges. And he made some really nice profits on those farms that he bought. But I watched him self-manage some of his assets and some of his single-family homes, and I just, from the time I was a kid, I was seeing this, I was like, you know what, there is no way I'm going to do that. There's got to be a better way to make money than that. So I said, I'm not going to do real estate at all. And more than just where I had some businesses, I got into business. Those are some of the businesses that this is our family business. Right there is my office, right in that building. We build modular buildings, and over the years, from the time I was a late teen, I invested in multiple businesses. There's some more of the businesses that I either founded or partnered with people, and we built. So I was very involved in those, and I got to the point where I was making a lot of money. These were very successful businesses, and my thoughts of investing back then was, you buy something for cheap and you sell it for a whole bunch. And I thought that was successful investing. And I remember I was reading Jim Rogers' book, Hot Commodities. And at the time, he was teaching me how commodities are very cyclical. And when you see a commodity, when you figure out what the cost is to produce that commodity, when that price dips down below the cost to produce a commodity, you go in and you buy. And he talked about, during that period, there's mergers and acquisitions, and big guys come in and buy the little guys. And So we went through a period where we used truckloads of OSB. It's like a roof sheeting, and so this stuff dropped down to below the cost that I knew that it took to produce the stuff, and we went all in. And I told my family, I said, we need to buy this stuff like there's no tomorrow. We had that building full of OSB. We had it outside. We had it tarped. So we were buying the stuff for like $5 a sheet, and I think we bought like 50 truckloads of it. And we had it stored all over the place. And less than 2 years later, this stuff was selling for $14 a sheet. And I thought that was investing, and it was so much fun. And it was fun. We made a lot of money, and it was fun making the money. But it was even more fun because I got it right. I called it right, and you know, once that happens, you just never forget it. But I thought I was investing. We were shipping buildings. We got modular buildings in all 50 states. Can you hear me all right back here? Shipping buildings to all 50 states. I was a private money lender. I was flipping a few houses. I was doing short-term capital gains, making all kinds of money, and having all kinds of fun until the taxman showed up. And I remember clearly I had just given over I had just hired a new CPA, and I thought that was going to take care of my problem. And I thought that, you know, they'll figure it out. They're the best CPA firm in the country. I mean, you know, they'll figure something out. Well, I remember the day, it was April 13th, he called me, my CPA called me and said, look, after you paid your quarterlies, after we, you know, took every deduction we could, you still owe $373,422 and some change. So I ended up paying around $500,000 tax that year. Around that same time, and Robert Kiyosaki was out there saying that you could make millions of dollars a year and you didn't have to pay tax, and it drove me crazy. There's a few times in my life, and I'm sure you guys have these moments as well, but there's a few times in my life where somebody said something or something happened to me where it made an impact, and that shook me up. I was like, I got to figure out what this is about. Tom Wheelwright, his CPA, told me if you want to change your tax, you got to change your facts. Which means if you want to change the way you're being taxed, you got to change the way you're doing business. You got to change the way you're investing. You got to change the way you're behaving. It was then that I realized, and this applies to a lot more than business and investing, but you can take the victim mentality. I thought that my problems were external. I thought that it was because the Republicans or the Democrats or the tax law or my problems were out here. Like if they would change this or if they'd do that it was then that I figured out that it's an internal problem. Are there people out there that are making millions of dollars a year and legally not paying tax? Well, sure there are. Okay, well, how are they doing it? So I realized that it was my problem. It was something that I was doing that I wasn't doing right. Let's get Mr. Trump's thoughts on tax. I want you to get this picture. High-paid professional, attorney, entrepreneur, businessman, investor. And she's accusing him of not paying tax and being a tax cheat and all that. And Trump said, well, that makes me smart. Well, he's smart because he knows the rules and he's playing by them. He's using the rules that are out there to his advantage. And the tax law is set up in favor of the entrepreneur, the investor, and the business owner. Do you think that the government would like to tax the one guy on the left or the 50 to 75 employees on the right? Well, they're going to reward the guy on the left who's creating the jobs. Had lunch with Mr. Shirky today, our senator up here, and I asked him, what's the number one thing, and I knew what the answer was going to be, but what's the number one thing that a senator, a politician, is concerned about? His area, his constituents, his jobs. So they're going to reward the guy that goes out and creates the jobs. They're going to reward the person that goes out and provides the housing. Does anybody in this room know of a government project that's run profitably? Housing, HUD, low-income housing, and all that stuff. I mean, so they're saying to an investor, look, Mr. Investor, if you go out and you provide housing and you build and you create a lot of value, provide jobs, provide housing for folks, we're going to give you a tax incentive. If you go out and take the risk and drill for oil, we're going to give you a tax incentive. If you install solar, I remember on the big manufacturing building of ours, Pennsylvania came out with a 30% sunshine grant for solar. They had $200 million set aside to promote solar in Pennsylvania. So you take that, you add that together with the 30% federal incentive, and at that point it made a lot of sense. So tax, if you guys are being taxed, it's because you're not doing what the government wants you to do and you're being fined for it. So always look at a tax bill as a citation. So that's not conventional thinking. So that's just remember, what's the number one thing people think of when somebody makes a lot of money and doesn't have to pay tax? And you're thinking, oh, he's a tax cheat and he's scamming the government and he's unpatriotic. Well, I would argue just the opposite. I would say that it's more patriotic to not pay tax, because you're doing what your government wants you to do. Your government is rewarding you for going out and doing the things they want you to do. And if you can know what that is and put yourself in a position where you can invest, do business, behave in a certain way, they will reward you for it. Anymore, we take tax planning very seriously. That's my CPA standing in the water, and that's all of us last year at sunny Belize. And this was like the firing range. He's out there and we're firing questions off as fast as he can answer them. So we get really serious about our tax planning. So I had a problem. They say that you can learn the most during extreme moments of pain or extreme pleasure. Your senses are most acute when you're having extreme senses of pain or extreme. I had pain. And I dove in and I started educating myself. I started getting around Kiyosaki. I hunted him down. I went on an investor cruise where him and his whole team, his CPAs, real estate guys, his oil guys, were all on a ship for a week. And I went on the boat, and it was life-changing. It was, and I would challenge you, if you are in a situation where you don't know what your next move is, you know it's possible, but you don't know how to get there. There's a couple ways you can go about it. You can put in the time, the study, the effort, or you can go find somebody that's doing what you want to do and take him to lunch and just sit down and figure out how he's doing it. And most of the time you'll find that somebody that's been very successful in that space is willing and able and happy to share it. So I surrounded myself with folks that were doing what I wanted to do. I took action. I applied what I was learning. I partnered with great folks who were successful in the asset classes that I was interested in. Proverbs in the Bible talks about wise counsel and that you should surround yourself with wise counselors. So I get around folks who have similar goals and ambitions, and I believe that's what you guys are here for tonight. I mean, you start rubbing shoulders with, everybody knows, I mean, it's a Monday night, and it's, you guys could be at home or in the pool or doing something more fun than educating yourself, but you're concerned about your future, and that's where I learn the most. When I get in a group of guys like yourselves, entrepreneurs, investors, business owners, and people that are concerned about their financial future. Most people in this country are more concerned, or they spend more time. They know their football team, every player on the football team, but they don't know the people's phone number, or they don't know them by the first name. The people that are or should be on their team that can really make a difference or an impact in their financial future. So once I figured out through my studies that real estate was a tax shelter, I got to the point where all of a sudden I went from I'm not gonna have any real estate to I can't get enough of it. So I started buying multifamily. I got to the point where I bought a couple hundred units of apartment units on my own. I used leverage. I used cost segregation. I was accelerating my depreciation. My depreciation. I was so desperate to get myself some momentum and free myself of the tax slavery that I was in, that I would have been willing to take a property at cash flow, at zero cash flow, just to be able to get myself to the point where I had the momentum where I could defer those taxes to the point where I could get that wheel turning to where I started getting momentum. Because once you get that momentum going, then you can take the money that you would have paid in tax and you can reinvest it again into another asset that will give you more depreciation. You get that momentum. See where I'm going with it? You start that momentum and you can start investing in a way to where it gets you real leverage and real momentum. So, a couple things before we get into some of these assets, and I'll explain them as I go through them. I remember I was sitting in a class put on by Robert Kiyosaki, and he told me that he takes his cash flow from real estate and he buys oil and gas. And didn't think nothing of it, but later on when I really broke it down, because I was taking notes, I was studying this stuff, and I really when you broke it down, okay, so you figure, okay, I invested in multifamily. I took the depreciation, I accelerated the depreciation, I took the cash that I was making, which was now tax-free, and I invested in oil and gas. You invest in oil and gas, you can get up to 28 to 30% tax credit, not a tax deduction, but tax credit the first year. So he's taking tax-free money and he's investing in oil and gas. And so just understanding depreciation and how it works, understanding debt and how to use it strategically. I know there's probably some in this room that are very debt averse, and understand that. Just understand that debt is like a chainsaw. If you use it correctly, you can get a lot of work done. You've got lots of leverage, but it can also take your leg off, and it can also be a very dangerous tool. Find out what your government wants. You find out what your government wants you to do. That's all it is. You find out what your government wants you to do, and you get in front of that, and you're able to be strategic with that. I tell my sons. Sons are 18 and 15 years old. If you go out and your number one focus is just to, you don't have to have your head in the sand. You're smart about going out and really making a lot of money. If you just go out and you're plowing full speed ahead and you're trying to make as much money as you can, and you're not strategic about how you invest it, or you're not strategic from the tax side, you're going to end up giving almost half of it away. So just knowing what the rules are, understanding them, and using them to your benefit. My 4 rules for successful investing, I wish I'd have knew this 15 years ago. My 4 rules are, they start with my personal investment philosophy. What is it that I want? What is it? I have a problem. What is it that I want? Well, for me, I had a tax problem. I had a bad tax problem. So I figured out that multifamily specifically is, when used strategically, can be a real tax shelter. I then went to a market that was known for being a really good cash flow market in the multifamily space. And after that, I assembled a team in that market, and only at that point then I went and let my team help me find the assets that I wanted to purchase. Most of the time, people do the opposite. People will go out and they'll look on LoopNet, they'll look on MLS, they'll run the numbers, they'll get all excited about the numbers on a certain property. How many of you know, probably most of you know, that the ones that pencil out the best, the ones that will give you a 30% return and pencil out the best, are usually the ones that are hardest to keep full? Well, most people go out and find the asset first, and they buy the asset, and then they run around trying to find a team. And then when they find a team, then the team turns up their nose and says, "Oh, you're on the wrong side of town, buddy." That's not. I think I want to manage that part of town. So if you can flip that around and go to the market that you want, go to market that you really like, where the jobs are, where the growth is, where the population growth is. If you can go to that market, then find a team, let them help find the asset. I made a call to a broker in San Antonio a number of years ago, and I said, look, if you had anywhere in your city, I knew I wanted to invest in San Antonio, but if you had anywhere in your city that you would say, man, this was also a property management company, if you were to say, man, if I could just have some of those homes in that area in my portfolio to manage, where would that be? So he took me out, and I bought a couple of new fourplexes, and those things have just been rock solid. They've been cash flowing ever since. He manages them. It's just you're shortcutting the process, and you're avoiding a lot of problems if you let a really good team help you find a really good asset rather than trying to do it on your own and go for the asset first. Another thing I learned throughout my journey was location doesn't matter. So the house on the left, I bought back in 2009 or 10, and it was 6 miles from my house. I never met the tenant. I was there 2 or 3 times. Cash flow on it was, after debt service was maybe $400 or $500 a month. Great property, worked out great. Had a great property management team. This tenant almost always was 2 or 3 weeks late with her rent. So almost every month I get an extra $100 in service fees. Made no sense to me, but it's fine. I mean, my property management team, twice I think they had to show up, had to threaten court, and then she'd come the night before and drop off the money at the property management company office. But the point is, I had a great team, so it didn't matter. I got to thinking, it wouldn't matter if that house was 6 miles from my place, but I could drive up to it, or if it was in California or even out of the country. The point is, I had a great team, so I didn't have to worry about it. The other thing I want to point out to you is, bigger is not always harder. The property on the left took more effort to get that loan than the property on the right. The property on the right we bought for, I think, 6 or 7 million. And it was easier to get the loan for the property on the right than it was the property on the left. Property on the left, cash flow is about $400 a month, $800 a month gross. Property on the right, cash flow is $150,000 a month. Property on the right took less of my time and effort than property on the left. $150,000 a month gross revenues. So bigger is not always harder. I also realized investing is a team sport. So property management team, broker, lender, once you get a really good team, now it's rinse and repeat. So it's a team sport, and I soon eventually started running out of my own money, and there was great deals in the marketplace. There was a couple things going on there that I was very aware of. Number one, there was great deals in the marketplace at that time. The other thing I was very aware of was I was the guy that my broker would call. The number one broker in the city was on my team. I was the guy that he would call when he had a hot deal, and I wanted to keep it that way. I wanted to be that number one call. So it was about that time I was invited to sit on the founding board of a startup bank. And it was actually the first charter license issued to de novo startup bank since 2008. I was invited to sit on the board of the bank. The other members, there was 10 or 12 other people around the table, and I remember a conversation, something like, we're not sure if we want to invest in the bank. Could be 5 to 7 years till you see any kind of return, but I guess it's better than putting our money in a CD, which at the time was running about 3/4 of a point. I couldn't believe what I was hearing. These guys were able to write 7-figure checks, and they were making investment decisions based on a 3/4% CD. So I was a good friend of another board member who's now chairman of the board of the Bank of Bird and Hand. I said to him, he's also my at the time my CPA, and he had bookkeepers in my office, and And I said to him, you know what we're doing here. Is there any way that we could take these guys that were basing their investment decisions on a 3/4 point CD and connect them with what we're doing in Memphis, Tennessee, where that last building was at? We were putting the deals together. We were making double-digit returns, and these guys are making a 3/4% return. Is there any way is there a need for that? And I would spell syndication at the time. Is there a need for syndication? He said, absolutely there is. So we put a deal together. And we bought I needed to raise $850,000, and I've never asked for money before in my life. I was known as the modular building guy. I was not known as a real estate guy. We put that deal together, and I want you to, these next couple of deals that I'm going to talk to you about, I want you to think outside the box with me, because some of these deals are very unconventional, and some of these deals are just you'll see they're unconventional, but they work. Sometimes you got to think outside the box. I mean, we did some really creative stuff that we've added a lot of value to our investors through, protecting them in a 1031 exchange and waiting to do the financing until after the transaction was done, and then doing a refi and giving them their cash back. I mean, it was all kinds of fun stuff. But typically, a syndication works like where there's a sponsor. The sponsor goes out and finds a great property. You can buy the property for $1 million. You go out and find 10 investors to put in $100,000. Or a lot of times, what we'll do, we'll have the bank bring in 75% of the money, and then I'll go out and collect 25% of the money, and we'll go do the deal together. So we've done a lot of that in the last couple of years. Multifamily, we have a couple thousand units in multifamily, mostly in Memphis, Tennessee, and Texas. I'm going to talk a little bit about great teams, because I don't want you thinking that you have to know everything about multifamily or ATMs or self-storage to go out and make a real impact and create a really nice financial situation for yourself, because you don't. You don't need to be the expert. In fact, I like to use the scenario in Malcolm Gladwell's book, where he talks about the 10,000 hour rule, where he says that you have to put in the 10,000 hours if you want to be an expert in anything. Well, we only got a few 10,000 hours in our lifetime. I was heavy in the modular building business, still am, so I knew that if I wanted to shortcut the process, I had to find the best team I could possibly find and then leverage that team. So I promise you, there's good people in this area that you can use, that you can build a team, and you can do far greater things by hooking up with a great team than you can do running around out there by yourself. This is my Memphis multifamily team. The guy on the left is my partner, and the guy on the right is our broker. Him and his 3 or 4 man team are involved in almost half the transactions in multifamily in the city of Memphis, 20 units or larger. We started syndicating. We started putting ATM packages together for investors. So I myself personally was an ATM investor since 2012. I got introduced to these guys. They're by a really good friend of mine who's now on my advisory team. I was a passive investor from 2012 to 2016. In 2016, these guys who I really got to I really got to trust, they're local guys in the Lancaster area, very well respected business owners. They came to me and said, look, we see what you're doing in the multifamily space. We took down a big portfolio of ATM machines. Up until this point, they had just been doing family and friends, and they sort of ran out of their own network. They said, would you come join us? And I turned them down at the time. I was involved in 2 different multifamily transactions, and I was busy. And then they came to me right at the end of the year, in late November, early December, and said, we're putting a special fund together. This thing is, you can write off the whole thing. You can write off the whole investment in year 1. Everything else is the same. Typically, it's a 5-year depreciation schedule. I said at that time, I said, you know what, that works for me. I love that. I invest for cash flow. I invest for tax benefits. You got both of those. So I took it out to my investors, and they liked it. This is the number one repeat customer that I have is my ATM investors. They love these things. They're like a collector's item. So there's investors of mine that have 7, 8, 9, 10 units of ATM machines, and they're into them for 7 figures. I started raising money for these for the ATM business, and to date, I've got I think I raised just over 25 million in the last year and a half, for 25 million in cash for ATM. Again, great team. I don't know the ins and outs of this market. I know enough that when somebody runs up to the thing and puts his card in there and takes the cash out, I get a piece of that action. That's all I know about ATMs. So again, don't think you've got to be the expert and go out and do this stuff on your own. You don't need to be the expert. You need to find the guys that are really good and have their niche thing that they're. I love it. Did anybody read The One Thing by Gary Keller? Great book. I love people who have their one thing, where they just really are good at one thing. And like my Memphis multifamily guy, that's all he does. My self-storage guys, that's all they do. So these guys are really good at what they do. Self-storage, another really good appreciation play, strong cash flow, really good team. I asked my partner, I said, well, what else do? Do you invest in oil? Do you invest in solar? Do you invest in, no, just self-storage. 42 or 43 self-storage facilities, and he's been doing it for the last 30 years. Those are the kind of guys I like to team up with. Somebody that's got their 10,000 hours in, and somebody that I can team up with and just leverage off of. A couple weeks ago, we were down in Fairfield, Texas. This is a distillation unit where coal goes in this side, and we take out of a ton of coal, 2.25 barrels of liquid come into that tank and get shipped over to another tank that's a couple hundred feet away from there. You take a $47 ton of coal and suck $365 worth of liquid out of that coal, and you can do 18 ton a day for that thing. Those numbers work, and we're excited about that project. Ends up bringing a product out of the coal. This is a heavy sweet crude oil, pretty much a main ingredient in pharmaceuticals, and this is a product that you use a lot in the fracking industry. It's a clear liquid. It's a clear liquid lubricant. We got involved with this project in 2013. You saw us on the beach there a little bit ago with our tax planning session. But this project we started in 2013, and we're the lead investor in this project. I'm telling you this. Notice that every project I have a team attached to this project. I want you to take note of that, because that's the reason these things have been successful for us. The quality of the team behind each one of these projects is the reason these guys have been successful. The Caribbean is full of development graveyards, and so when you do development, it's a risky project most of the time. I mean, you look at development right now, you got price inflation, materials rising, you got interest rates going. I mean, there's some stuff going on that you can't control. You take that overseas, you can 5x the amount of risk that you got in a development project. So it's super important to have a great team. I teamed up with these guys just simply because of the team. I knew them well. Later on, it became even more obvious. Hilton recognized the quality of the team, the quality of the asset. We opened in December 6th of last year, about a half year ago, as a curio collection by Hilton. And we're also part of our resort is affiliated with, it's branded Coastal Living. I don't know, anybody familiar with the Coastal Living brand? Okay, couple. Great teams. They allow you to play offense. Once you take your eyes off the asset for a minute and think about team first. asset later. Don't worry about the asset for now. Great teams allow you to play offense, not defense. Great teams allow you to be bold. You can be aggressive. You can take calculated risk. The reason I'm showing that building there, we built those buildings in our manufacturing facility. We got into the self-storage business, and I was like, now wait a minute. Our tenants, they're driving across town to take their junk or their treasure to a self-storage facility across town. I got a big parking lot behind my apartment complex. Why not build a self-storage unit, a portable self-storage unit? So we built that at our facility and shipped it down to Memphis, and it is now, for what we paid for the building, it'll be paid off from the rent. It's set up to where it'll be paid off from the rents in less than 3 years, right around 3-year mark. And from that point forward, now you've got all that free cash flow. And now what does that cash flow do to the NOI? And what does the NOI do to the value of the property? A $12,000 investment. $12,000 investment gave us $73,000 in value because of that chain of effect. Portfolios of ATMs. We got a great team. The great team. We go out and bid against. We go out and play with private equity firms. We go out and play with the big boys, and we're able to win because we got a great team. So take action. Go find a great team. Go find somebody that has a strength that you don't. Go take action. Don't wait till all the stars align. Just do it. Life rewards action. So not everything has to make sense. Yeah, you want to do your homework. There's never a time when you head across town that you don't leave home until all the lights are green. Just take that into your investing philosophy and just go out and take that one step at a time. Trust your team. Once you got a really good team, it's a whole lot easier to do. And then there are going to be hard times. I showed you my partner on the left in Memphis. This is a guy my age, early 40s. He did 1,200 push-ups a day. He was built like a machine. Picture of health. He's got cancer, and so he's going through a rough spot right now. They took a baseball-sized hood out of his neck, and so he's going through a rough time. But you're going to go through hard times. You're going to, maybe not health issues, but there's going to be issues. Anything you do, anytime you do anything worthwhile, there's going to be issues. The easy stuff, you don't want to do the easy stuff. So just recognize if it was easy, everybody's doing it. Warren Buffett says, if you don't learn how to earn while you sleep, you will work till you're dead. There's a lot of ways to make a lot of money. You can be a house flipper. You can do a lot of, short-term capital gains. You can do a lot of things that I was doing. But I love building cash flow streams. I love building passive income streams and stuff that works for me while I'm here. Stuff that works for me while I'm on vacation or while I'm sleeping. So learn how to build cash flow streams that'll work for you. One of the reasons I do what I do and come out to places like this, obviously it's because I've got friends here and all that. But there's a couple reasons why I do what I do. These are some of the comments that I've gotten from my investors just recently here in the last couple of months. Today was one of my best April tax years ever, thanks to some of the strategies from you, and some of the other comments there are just very rewarding to me. Make an impact. Use the resources God has given you to make a difference, and just go out and make a difference. Anybody here read? One of you mentioned Phil. Mentioned Go Giver. That's one of my favorite books. I try to read Go Giver at least once a year, and it's required reading at my house for my teenage boys. If you haven't read the book, read Go Giver. Great little book, easy read. Find needs, fund them, be an asset in your community. Just once you get that network build of investors and you can go out and do deals together, just find ways to add value to your group of investors and be an asset in your community. My friend Tom Hopkins says, use money and love people, never use people and love money. So just something, Go Giver that aligns very well with the Go Giver book, but it's just a special little book that I keep trying to keep when I feel myself going off course. A great reminder to read that book. We're going to talk about conventional versus unconventional a little bit here. So conventional, one of the things conventional wisdom tells us that if you invest for the long term in a well-balanced portfolio of stocks, bonds, and mutual funds, you should make about a 7 or 8% return over the long term. So partly true. If you look over on the right, after you take out the fees, you take out inflation, and then at the very end, you then get taxed on top of it yet. There's not a whole lot left. You talk about real estate. If you find a good piece of real estate, and you buy it in the right time in the right market. Let's say you're getting a 7% cash flow. That's a modest, that's a very doable cash flow stream. But that's only part of the story. The government gives you 3.6%. If you buy it in the right market, the right place, the right time, you get another 4% easy. That's a ridiculously low projection, but 4% easy. You take your interest tax deductions, you do your amortization where the tenants are paying down your debt while you're collecting the cash flow. After a while, you take it from a 7% to a 16% return. So those are kind of the hidden things and the two differences where one is going like this, the other one is going like that. And just something to keep in mind. I did this a couple weeks ago, so this number could be slightly off, but we didn't move much since then. Stocks are not often priced like this. The average price to earning ratio across the S&P 500 is approximately 24. So when Dave or Mike, when I come to you and I want to buy your business, about what earnings multiple would I have to pay for a business? Typically across the market. 24. You would take 24. So if you go with 5 times earnings, it's kind of a little bit of maybe a rule of thumb, but 5 times earnings. Well, if you're buying into the S&P 500 right now, you're paying 24 times earnings. So just keep that in mind and know what cycle you're in at the time. Only 2 times in the last century was the ratio higher. Just before 2008, or just before 2000, just before 2008. So this isn't some kind of conspiracy theory. It's not some kind. These are facts, and we tend to forget them. So think about that. That is my contact information. I would love to, if you guys email me and get on our mailing list. I put out a newsletter. I put out stuff maybe once a month. I won't flood your inbox, but our deal flow goes out to that database. So if you send us an email, we will put you in our database, and you will hear from us. So I would love to take your questions. If I said anything that stirred anything in your mind, and you have a question on it, feel free to fire away. I understand we have some CPAs in the room. Did any of that was I totally off base there? Was what I was saying true?
What you're saying is true.
There we go. Any questions for me? I'd be happy to answer them. And I'm planning on being around here. I'm happy to be the last one here, so I'll be here all night.
Why Texas and Memphis?
We like to see a couple things in the market. Number one, we like to see jobs, and also very specifically jobs that can't be shipped overseas. Medical, energy, distribution, those are some of my favorites. So if you look at Houston, if you look at Dallas, if you look at San Antonio, those markets are heavy medical and heavy energy. If you look at Dallas, we also got distribution in there. Memphis is heavy medical, heavy distribution. Home of the world's busiest cargo airport. So jobs that can be shipped overseas. We also look at population growth. We look at job growth. You look at those markets and you look at where the growth is projected to be over the next decade, southeast. We look at a whole bunch of different metrics, but one of them is U-Haul. U-Haul, the stats of the U-Haul trucks going into a state or city loaded versus coming back empty. That's just one of them. But we love those markets. But mostly, like Mike said, mostly about job growth, and migration. Yes.
As you depreciate, I'm not sure how it goes in real estate, but do you have a recapture of that when you sell? And if so, how are you dealing with the tax on the gain at the exit? Do you not exit, or what's
so we don't exit often. We invest for cash flow, but we do sell occasionally. There's a number of ways. You can use 1031 exchange. This year, however, we sold a 120-unit building that we bought for $20,000 a door and change, and we sold it 2 years and 2 days later for $36,000 a door and change. So we had a big profit. We had a 7-figure profit. We chose not to do the 1031 exchange because of the new tax law. The new tax law says that now you can use bonus depreciation on used equipment. So now your used multifamily building, you can use 100%. You can do two things. You can use 100% bonus depreciation, and you can accelerate the depreciation. So it really became a thing of where, okay, you can either do a 1031 exchange to get to a tax-free, to get into a tax-free situation, or you can just take the cash, redeploy that cash in the same year, and then use accelerated depreciation and bonus depreciation to offset the gains on the sale. So again, that's a rule that just came out at the end of last year. So just to be aware of the new rules, I'm talking to my CPA at least once a week, and just be aware of the new rules and how you can use them to your benefit. You don't have to worry about the 45-day window to locate the property, the 180-day window to close on the property. There's no rules. All you got to do is redeploy the capital in the same year, and you can offset that gain.
Yes. What are you doing in order to identify these great teams, and how do you decide whether or not these are going to be part of my great team?
Probably the thing, there's a number of things, but probably the thing that speaks loudest to me is when there's a number of people and there's a number of investors in my network that they're ranting and raving about this team that they're doing business with, and they introduce me to this team. And let's just take the self-storage team that I partnered with. A couple investors in my network had done a total of 11 deals with these guys, and they couldn't say enough good things about them. I still did the credit check. I still did the background check. I still brought them up to my advisory team and interrogated them for an hour and a half before I even flew down with my team to go see their assets and see their team. There's a number of steps we take, but probably the most important to me, I don't care as much what you say about you as I care about what these people say about you. And that's how I look at my team. If there's people in my network that are saying really good things about a team, that's a great start. And that's where I get most of my leads. My coal investment came to me that way. I get introduced to great people because of people in my network. Yes.
How did penetration into the, let's say, Houston network to know people that were in that neighborhood as opposed to the neighborhood you come from, the place you came from? So it wasn't a natural place to go down and build a network in Houston, except that you had investors from Houston originally in some other part of your deals, or where did those guys come from?
We did are you talking about a multifamily project in Houston?
Yes.
We did a
anything. You're still identifying a piece of geography.
We did a multifamily deal in Baytown, Texas. I did it with a guy who I was part of a syndication mentoring club, And I watched this guy for 2 years do deals before I approached him and said, hey, let's partner up on your next deal. So just by watching him, getting to know him really well, getting to see him do deals, and then talking to his property management team, his lender, a couple other guys who I knew who did business with him, and just by going around asking questions, fact-checking, verifying, but most of all, building a relationship over a 2-year period and watching do deals.
Syndication Mentoring Club.
Yes.
Question.
So Syndication Mentoring Club is exactly what it sounds like. It is a group of professional syndicators who take a group of, say, 12 to 15 students under their wing and teach them everything they know about syndication. I was in that group as a student. I was in that group for 3 years. It was a 2-year program. It took me 3 years. I'm a little slow sometimes, but I was in that group for 3 years. I then sort of graduated from the group, and then they brought me back in as an advisor to the group. So now, every September and March of every year in Dallas, there's a syndication, a Secrets of Successful Syndication in Dallas, put on by the Real Estate Guys. So, realestateguysradio.com, go to the events tab, and you'll find, in their events, you'll find the syndication mentoring, or the syndication event in Dallas. Great group of guys. That's where I learned how to do syndication.
And syndication is just a word for putting a deal together and raising money from people.
Yeah, I mean, you can syndicate a single-family home. You can get, you could go find the deal, and you could put your sweat equity into the deal, and you could, put the financing package together, and you could go out and find an investor to come in and do the deal with you, and you guys could split up that's syndication. Yeah.
Yeah, I'm a little naive or confused. Are you here to motivate us to get into investing, or can we ride your coattails and invest in things you're looking at, or? I mean, because my dad and I have invested in projects. We did this lifetime tool. It was a plastic mold injected head. We were going to sell to Home Depot. Went through all the trials. And of course, everybody wants you to come into their team because they need your funding. And then, of course, we lost at last minute. We did on the west side of Fremont, they were going to, all the farmers were going to put all the old apples and sell to consumers at a guaranteed rate. And of course, we get on that deal, and that went sour because there's embezzlement and stuff like that. But so everything sounds great. I mean, I listen to Business Week. Everything sounds great, but as you know, it's timing. It's just luck. I mean, so for us to put a team together, it just seems tough. Unless I'm wrong, as I'm confused. If you're just here to motivate us to do that, or
so I do occasionally have a deal available. I mean, I've got a self-storage deal available right now. I mean, I'm not here specifically to promote it, but there is a self-storage deal available right now. I'm here because Dave asked me to come out and speak to you.
I just want to learn. I mean, everybody that pitches that needs your money. Everybody needs everybody else's money, and it's like
maybe take us back over the last 12 months. Not that you can remember everything, but just say, here's the 5 or 6 deals that you've brought to the table and have been invested in by your network.
So we did 2 self-storage deals with our team. We haven't done a multifamily deal this year yet. We plan to in September. We did an ATM portfolio this year. We're doing deals, and we're constantly raising money for deals. I will tell you that a lot of our deals are getting funded quickly. That Cole deal, it was a $2.15 million deal. It funded in an hour, just over an hour. So I'm not here. That's really not the motivation to be here. Is to raise money. But yes, I mean there are opportunities too. Sure. So if you get on that, if you send us an email and you get on in our database, you'll see our deal flow. Mm-hmm. And there's special treatment to. There's a few of my investors in the room. Those guys see the deals first. But once you get into the deal flow and you do a deal with us, you'll see the deals first. So there's
I'm not opposed to it. I just wanted to know. I just didn't know what I was looking at.
Yeah. So there's opportunity there for sure. But the other thing is to motivate you.
I mean, I get all about the
give you
tax.
some ideas.
Taxes are huge, but
I'm gonna have a deal for you.
I'm good. I mean, because you're right. I mean, everything's tax loopholes and getting around it. I mean, let's be honest. And it's like I need a CPA, so I need like 2 or 3 people on a team.
And you'll find too that once you find a really good person, let's say a broker or a lender, if you find an all-star, you don't have to go find 5 all-stars. If you find 1 all-star, those people, if you find a really good, my property manager, I mean my broker in Memphis, best broker in the city, you can bet he's not dealing with shady, crooked guys. Those guys have really good people on their team, so they can point you in the right direction. Like, hey, who do you know? You know a lender. You really only need to find 1 or 2 great people, and they'll point you in the right direction.
Well, it seems like the most important person is the CPA because he knows all the tax laws. I mean, that's what you're kind of working with the real estate deal, right? I mean,
It's very important to have a good CPA in your team, yeah.
So Dave,
Yes.
you talked about some of your victories. Can you share with us some of your losses and how that happened?
Yeah, so my very first deal I did, my very first big multifamily deal that I did was a 72-unit deal. I made a lot of mistakes. I ended up being the only investor in the deal. This guy was a syndicator. He put the deal together. I ended up being the only investor in the deal. Mistake number 1. I got emotional about the deal. Mistake number 2. I thought, he was a good sales guy. I thought it was the best deal ever. We were going to hit a home run with this deal. So I put $750,000 of my own money in it. And about 3 or 4 years later, I got $245,000 back when we unloaded it finally. So yeah, painful lesson. But when I look back,
What was the cause of the demise?
What's that?
What was the cause of the demise?
Incompetence, bad team. Yeah. So when I look back at that, I could cry about the $500,000 that I lost. But when I look back at that, that's probably the reason why I spend so much time on and focus on the team today. Not some instinct I was born with. It got pounded into me pretty hard.
Dave, have you had any deals that you've led in the past 8-10 years that have kind of gone south?
I did a deal called Hunter's Ridge, and you guys that are invested with me in the room will have seen this on my newsletter, where it underperformed. Didn't cash flow anywhere near what we projected it to, and I ended up giving the investors the option to sell me their shares. All but 2 of the investors took me up on the option, which I can't blame them for it, but I bought them. I own that now, along with 2 other investors. Now, I don't think for 1 second that I'm offering that to you tonight, because you can only do that so many times. But there was some mistakes made on the due diligence side, and it was one of the very first ones we bought. I think it was the second one we bought in Memphis. There were some due diligence mistakes made. There was the area where we were in really should be, there should be public transportation to that property. It's a C-class building, so a lot of our tenants there don't own their own vehicles. We thought being close to the Nike plant would compensate for that. There's also poor phone reception right there. So a combination of a couple things on the due diligence side that was mistakes that we made. So yeah, I'm looking to unload that property. If anybody wants 138 units in Memphis, Tennessee, I'd give you a good deal on it.
The modular storage unit that you put in the parking lot.
Yes.
Doesn't it get you in the position of having to fight the zoning battle with little community by community when you get into something like that?
It does. This was a test case, and it was a little bit unique. I wouldn't do it anywhere, but I wouldn't be afraid to do it in well over half of our properties either. This was a large parking lot in the back. It was not going to be seen by really anybody but the tenant. So if you're along a busy highway, I wouldn't put it right along the street. But if you can stick in the back somewhere, it is not something that we went out and got permits for. But on the other hand, if the city came by and said, "Oh, you got to get that out of there," it's portable. You can come in there with a truck and trailer and get it out of there in no time flat. So we were prepared to, we're prepared to move it if we need to. Yes.
Do you own mutual funds?
No. Yeah.
You mentioned investing in oil and gas and a 30% tax credit. Can you explain that?
So.
Dave, can you get the question over?
Okay, yeah. So the question was the tax credit for oil and gas. So what the government says is when you invest in a specific drilling fund, so there's different funds that you can invest in when you invest in oil. There's some that you can invest in where you invest into more of an established field where they got the well drilled and now you invest for cash flow. But then there's some fields where you go in and you're drilling the wells. When you go in as a drilling fund, you can, if you invest $100,000 into that fund, you can get $28,000 or $30,000 back as a tax credit. Meaning, if your tax bill for that year was $100,000, it's not a tax deduction; it's cash. If your tax bill was $100,000 for that year, and you invested $100,000 into oil and gas in a drilling fund, you would be able to take $28,000 to $30,000 off of your tax bill for that year, and that's not counting any cash flow from your investment. That's just the government saying, here's $28,000 or $30,000 for taking the risk to go out and invest in oil. And like our coal investment, that deduction can go against your ordinary income. So it's very different from most depreciations, where the depreciation just offsets your passive income. When you're talking real estate and just about any other asset class, except for oil and gas, solar, or coal, liquid distillation process, those are the few that you can use against W-2 income, ordinary income, whatever. That's a big deal. That's one of the things I'm really excited about. That you can, number one, you can use bonus depreciation, strong cash flow, and you can offset your ordinary income.
Dave, how do you guard against the risk of changing tax law? So all of a sudden you do up the math and the math works because you get this 30% tax credit, and then an election comes around and that's not there anymore.
So in that case, you get the tax benefit the first year, in the year that you do it. So by the time that tax law change came about, it would be done. They would change it in future investments going forward, but not withdraw. Or I'm hoping they would.
Dave, you mentioned ATMs, which would not be anybody's list in this room of that being a traditional real estate investment. What other kinds of assets fall into the category of real estate that are not even what you think of as real estate?
What other categories would fall into real estate that people would not think of as conventional? Are you talking different niches of real estate?
Yeah. So maybe storage.
Yeah, I mean, I would love to own airport parking. Every time I parked my car there this morning to come here. Ruin this place. I mean, there's all kinds of little niches that I hear about today. I'm thinking, I never thought about that. It could be parking garages. It could be, any kind of niche that, I mean, most people look at an ATM and they think the banks own them. That's probably the number one comment I get is, oh, yeah, I thought those are all bank owned. Nobody ever even thinks about ATMs being able to, as somebody being able to invest in them.
How about toll roads and stuff like that? I thought in 08, 09, the states were starting to sell those off. The bridge to Canada, all that stuff. I mean, those are all independently owned by Australian companies. I mean, can we bet on that stuff? Can we get them that?
I didn't run into my team yet for that one, but yeah, I mean, it's a very niche product. But yeah, I mean, the one that comes to mind immediately is airport parking. I love that. I mean, I'd love to own a couple of them. That, and I think it could be a real disruptor going on there too, because if you could almost automate it, I think. I mean, why couldn't you hire Uber and Lyft and give them a parking space next to your lot and just have a kiosk that somebody could go push the kiosk and here comes Uber and Lyft, and you wouldn't have to worry about employment. You wouldn't have to worry about buying vans and employing people to come and haul people to the airport in the middle of the night. Yes.
Dave, what are you doing to help your children maybe get a head start, learn some of these concepts?
There is some required reading. There is
by you.
Oh yeah. There is, if I run across a podcast, in fact, I'll give you an example. There's a great podcast that I listen to every week. It's called The Self-Made Man. And a couple weeks ago, he had this is a great idea for you guys. This will be worth your trip down here just for this. So, listen, go back about 3 weeks and pull up a podcast where they talk about Airbnb. So what comes to mind when you think about Airbnb as an investor? Conventional route would be to go buy a property and put it on Airbnb, right? Well, why couldn't you put an Airbnb on a 12-month lease? I mean, you have to work it out with the owner, but now you're $12,000 out of pocket or $1,000 a month or whatever the number is, and you're making your, assuming it's a great area, and assuming that it's a high demand area, you're making your monthly rent payment in 4 or 5 days, 6 days,
Without owning it.
So it's like $12,000 a year out of your pocket. You could be onto some massive cash flow business, and he talks about that in the podcast. Just stuff like that. I love that stuff. We're going to. When we go travel and we have an event at a hotel, we got an event coming up in a hotel. It's in a beautiful Hilton, but we chose to go to a little Airbnb place. I love that stuff. Yeah.
So what's your one thing at this point?
My one thing is. Oh man, that's a great question.
Can I answer it?
I love what I'm doing. I love what I do, and I get. Not only do I get a real, I get motivated by when I hear somebody that said that about April 15th, and I get quite a few of those. I get voice messages and emails, oh, this stuff really works. Like that stuff gets my juices flowing. And so if I can teach young people, if I can get them thinking outside the box, if I can get them thinking unconventionally, I love that stuff. Yes.
So can you kind of flesh out Dave's question, which was what you do with your own children to teach them? Because it seems like you've got something going with intentional growth or intentional education.
That's where I was going with that podcast. So, and I got off track. Yeah, so I heard the podcast, and I immediately told my 18-year-old son, you got to listen to this podcast. And so he listened to the podcast, and now he's looking for a house somewhere in our area that he can put on a contract and go out and be. I mean, he's got the whole thing planned out. He knows who he's going to hire to clean it, and he's got it all figured out. He knows who he's got to clean it already. He just don't have the house yet, but that's in his plans is to put a house under contract for a 12-month contract and Airbnb it. Teaching them that kind of stuff, teaching them to think outside the box. There's a few times when I will pull one of them aside and I'll tell them, like, this is the time. This is one time. Like, we're chatting back and forth and we're talking like, just like we do. But then there's a few times when I'll pull them aside and really get serious with them and say, look, this is something that you need to think about, and you need to write this down, and because this is how it works in the real world. You know, he took my 15-year-old aside, and he's got this. I bought a patented plate that he needs to run through a machine. And so it became his business, and it's the only reason I bought the patent was because I needed something for him to do. But he's now handing that off to his brother and sister, who are 11 and 9. It's a real easy thing. You can crank out a couple hundred plates, and they get 5 cents a piece for doing this. Well, now he's stepping back, but he's still got to help them box them, and he's still got to help them, load the van to take off to where they need to go. And he's now thinking in his mind, oh, well, he didn't bend the plate, he don't get the money. And I said, look, you have a skill. Over the last couple of years, you've developed a skill. That skill is worth something. They can't do the whole thing. You got to help do maybe 5% of the work. But your 5% of the work could be 25% of the pay. What I was trying to teach him was you create a skill. You create a skill, and once you have that skill, now you can demand a premium. So just life lessons that I try to really be intentional about, really kind of soaking into their head, that kind of stuff. Yes?
The multifamily markets that you're in are highly competitive. What sort of cap rates are you investing in? And then also, what sort of amortization schedules are you using on your leverage?
So you're right, and that's why we haven't bought one this year yet. Last year we bought, I think it was 600 or 700 units, and the ones that we buy, they're C-class value adds, 8, 9, but even those, they're getting competitive, and that's why we haven't been in acquisition mode in this year. And there's. I'm not saying we're not buyers. We are buyers. We get the right deal, and you can be. We've found even the last 2 years, we've found that the deals that we bought, we had to get creative with. Like we went in and bought a couple for cash, and then after and one of the reasons we bought them for cash was because we wanted to show up as a strong buyer, and our broker could go to the seller saying, look, these guys closed 22 of their last 22 deals that they went on a contract with, and they got cash. There's no financing contingency. We bought properties like that. We were fourth in line as far as the bidding depth. I'll give you an example. One we bought a 66 home development. We bought the whole development. It was some government project. It wasn't HUD, but it was some kind of a subsidized project. Well, we bought it. We lost it. Get these numbers straight. So it was like our bid was 2.2 million. They put it on a contract for 2.8 million. The asking price was 2.975. They put it on a contract with the highest bidder at 2.8. Like 3 months later, it's back on the market. They're going to get financing. When we showed up, we didn't have the financing contingency in there. We came in with cash. We closed within 30 days, and we took it down and 2.16 or 2.2 million. Incredible deal, but we had to get creative and think outside the box.
Are you getting 8s and 9s and then rehabbing them, or is that after the rehab?
Yeah, we were doing 8s and 9s and then doing some value add. We weren't doing heavy rehab. We were doing paint and carpet and basement and soffits and parking lots and that kind of stuff.
And the hand schedules?
30, if we can. 20, sometimes 20. It'll 25 or 30.
Because if you're at 7, it's like your presentation showed, you wouldn't cash flow if it wasn't at 30.
So if we go to a local lender, typically we got to settle for 25. If we get something that's a little more stabilized, where it's in the 90% occupancy rate, then you can go with an agency loan and get 30. You won't have to chase me off here. How much time I got?
Well, 8 o'clock is our hard stop. But if there's questions, we'd love to have them. So, Mark?
Yes.
Yeah. What's the process of finding rental unit developments in an area? Are you looking for groups of units where they've got 8 or 10 properties together in a package, or are you actually going out finding and picking off individual systems?
So
self-storage systems.
Oh, okay. We're talking self-storage.
Self-storage. Yes, I'm sorry.
Ask the question again, please.
How do you go about with your network finding self-storage opportunities in various markets that you're working in? Are you looking for multi-unit properties, or are you picking off the onesie twosies too? And where are those found? In the real estate community, or is there a better place to look?
Yeah. So most of the business we're doing in the southeast. A lot of them we're doing in Florida. And typically we're not buying anything much under 40, 50,000 square feet. And when we are buying in that range, 40 or 50,000 square feet, I'll give you an example. We bought one in March, 8 million-ish. When we're done, it'll be 12 million-ish. It was a 70,000 square foot facility, 530 some units. And when we're done with it in 12 to 14 months from now, we're going to be adding 50,000 square feet to it, and about 400. It'll be about 950 units when we're done, and about 75,000 square feet. So typically, it's just like he mentioned, trying to buy a stabilized asset in today's market with good cash flow. I mean, they hardly exist.
People chase them.
So you gotta find an asset and do something with it. You gotta add some value to make it make sense. The project we're working on in Key West right now, which is open, we're funding right now, is 37,000 square feet. So it's a little under our kind of threshold that we usually operate in, but we can add 17,000 square feet to it. So again, just you've got to find a way to add value to it, or it doesn't make sense.
And Dave, like, I don't necessarily think you're really finding these. You vetted out a couple of self-storage operators like Reliant and are betting on them. And when you prove out the offering they have next, you'll bring that to your investors.
Yeah.
You're not.
Yeah. So I'm not going out and looking for it. Good point.
So are real estate investments getting frothy like the stock market is?
Let's just say this: there's not deals everywhere like there was a couple years ago. It could go on for a couple more years. I don't know, but it's getting harder to find properties that make good sense. I mean, for us to go to at some point there's a threshold when you get in your could I sell a deal that's putting out a 5% cash on cash return? It'd be a tough sell. So at some point you just got to say, well, hey, this is my minimum threshold, and I'm not going below that. And it's getting harder to stay above that threshold.
Do you think there's other opportunities? You were doing the oil and gas, but in like alternative energy coming out that the government might be doing incentives for?
They will incentivize anything that they think is not anything. They will incentivize things that they think are important to them, whether it be through creating jobs, whether it be through, Mike, you would have some. What do you guys look for? Like when you're going out, the question. Did you hear the question?
I did, and you should not assume that things that government tries to subsidize make any sense.
Exactly. Yeah, that's close.
It's already posted on your next election campaign, right?
Yeah, well, you should be our president. Anybody else?
I thought you might mention some of your thoughts on how you learn to use life insurance.
I use a whole life insurance policy. So it's basically what we do is we'll take a policy and we'll take the cash value and we'll borrow against it. There's something else I want to share. I'll share on that first. All right, so let's just say that you invested $100,000 into a whole life policy. You can then turn around and borrow out, say, $90,000 or $95,000 of that, and go invest it in something that will give you cash flow, which then your cash flow flows back into the insurance, to build up your cash value again, and you keep borrowing it back out. I've used mine like that for the last probably 5-6 years. Yes.
So I told my dad that he wasn't allowed to make statements tonight. That's going to be our next meeting like this. Talk about how to use high cash value life insurance.
I'm certainly not the expert in that case, and it's quite confusing. It can make your brain go dizzy. So I'm certainly not the expert on that, but I've done it for. I mean, I know the basics. I've done it for the last probably 5, 6, 7 years. Go ahead.
Using the SBA programs at all, like 7A or 504? Anything
Never
like
used
that?
them.
No.
No. High-paid professionals. Business owners with revenues over $5 million. There's another strategy that we used in our company, and that's through a captive insurance. Anybody here using captive insurance? A couple guys, yeah. Basically, you are the insurance company. You create an entity. This is a highly regulated space, so you got to make sure that you have the right people on your team to do it. But let's just say, okay, so you create a life insurance company here. Your business is over here, all right? So your life insurance company bills your company. Typically, it's in products that you would not insure yourself in. They're very high margin, low probability insurance products. But what we did in our company is we got a feasibility study done. The company came in and told us what we could insure, and we ended up taking $800,000. Our insurance company billed our company $800,000 for insurance. We still kept our regular liability insurance, but what happened then is you create an expense on the company side. The $800,000 is now laying over in our insurance company. It has to lay there for 12 months or more. That's your float. And then two things can happen. One is you can take a distribution and pull the money out of that insurance company at long-term capital gains rate instead of ordinary income tax rate. Or you can use that as your bank and borrow it out tax-free. And that's what we're doing. So you have an insurance company. You've got the insurance company. You bill your company. The money comes back comes over here to your insurance company. Warren Buffett is the largest, Berkshire Hathaway is the largest buyer of captive reinsurance in the country. By the tune of hundreds of millions of dollars a year. It's regulated. There's very clear, specific rules. If you borrow the money out, it's got to be treated as a loan, and you got to make the interest payments that are reasonable. So it's, again, you need to have a great team around you. That's their one thing. That's all they do is captive insurance. We do some pretty cool stuff together. My investors will be invited down to Belize this winter. Our captive insurance guy will be there for 4 days. Our coal guy will be there. Our self-storage guys will be there. My CPA will be there. And probably 15, 20, 30 investors will be there with us. And we'll be out on the beach again talking business. So, pretty cool.
One book that you'd recommend?
I would say Rich Dad Poor Dad, but probably everybody or most of you have read. Who's read Rich Dad Poor Dad? Yeah. So we, my 3 brothers and I, and about 4 or 5 other local business guys around home, do a book study a month. So every month we do a book study. Tonight is our book study meeting at home, and this month it's Richest Man in Babylon. Who's read Richest Man in Babylon? Yeah, the book was written I think in 1926 or something like that. Great book. I mean, just very sound, common sense principles. That's also required reading in my house. Compound Effect, Darren Hardy, that's a good one. Yeah, those would be my top two. Okay. Anybody else? Yes.
So you've been doing this heavy since 2012? So you haven't been through 01 and 08 yet? So
I started in 2010.
Okay, but still past 01 and 08. So
yeah.
what, if anything, are you doing as you see this like stock market signals and some of the concerns about that we might be in those two areas?
Couple things. One, we are pruning this year. We'll be selling a few assets this year. Something I don't like to do, but we sell rarely, but we'll be pruning this year. The other thing we're doing is we're making sure that the balloon payments that are coming due in the next year or two, we're taking them out 10 to 12 years, refinancing, trying to get our house in order, and making sure that we can ride through the ones that we're keeping. We're making sure that we can ride through the next downturn.
Yes, that's what Ford did.
What's that?
That's what Ford Motor Company did.
Oh yeah. And they survived.
About government assistance.
Yeah. Anybody else?
Where's your next? How often do you do this? Like, is this normal or?
Not real often, but probably. I mean, it comes in spurts. Like it might be an average of once a month, and sometimes it's a local group around home that's 30, 40 guys. Sometimes it's the one I do in March and September in the Secrets of Successful Syndication in Dallas. It's usually around 250 to 300 people. Those are that's a really good event. Going to Destin, so I got a really good stretch just in the next couple of weeks. Going to Destin this weekend. A couple of investors in my network they have like this whole dentist mastermind group, and they're getting together in Destin. They invited me to come down. So this weekend I'll be in Destin. So not often, but probably on average, maybe once a month or a little less.
So your follow-up question is, when's the next time you're coming to Jackson?
I don't know. It probably depends on when I get invited next. I might come back just for that trout soup.
Trout or salmon?
We had
trout chowder.
We had trout chowder at his restaurant today. It was the best trout chowder I ever had.
Or if you get invited to hunt.
No, it's not getting invited to hunt.
Yes.
You mentioned God a couple times. Can you talk briefly about your charitable work?
About the charitable work? Yeah, so last year, I am not very active in Africa or Haiti, offshore. Have nothing, there's nothing the matter with that. But me personally, I like to do stuff local. And so I set up this fund for widows around home, and whenever there's a widow that I know of, a lot of times, especially in our community, you have this outpouring of support right away at first, and her debt gets paid off, or they try to put her in a good position, but then she can get somewhat forgotten. And so I set it up to where I'm the cash flow guy. So I put them on a program where I give them a certain amount of cash flow per month. And so last year I put 2 units of ATMs in that fund to support widows. So that the cash flow. I mean, there's a couple ways you can do it, and oh man, this is a good tax strategy. All right, so there is a way that you can give a gift of $252,000 for $2,400 out of your pocket to Would you like to hear it?
Yeah.
All right. So, anyway, so I put the 2 units of ATMs in there. Now the cash flow comes out of those, goes into a donor advised fund, and then somebody at our church cuts the check to these widows every month. So this is a pretty cool tax strategy. You can use what's called a charitable lead trust. The way that it works is a unit of ATMs costs $104,000, and you can take that and you can use the bonus depreciation or Section 179 and write off the whole $104,000 in the first year. All right, so now you own the ATMs, but now you turn around and gift the cash flow, 7 years of cash flow, 7-year contract on the ATM investment. You go ahead and gift the future cash flow on that ATM. So, and that's $178,000, which needs to be discounted. There's some kind of a formula you use at a CPA's office that when you give future cash flow, you got to discount it by a certain multiple. So of that $178,000, I can also take the tax deduction on that $150,000 gift. On that $178,000 gift, but he's reducing that $178,000 by $150,000 or to $150,000. So I'm taking the $104,000 and the $150,000 in future cash flow. I'm taking the depreciation on both of those. I'm writing both of those off in the first year. So out-of-pocket cost, that first year out-of-pocket cost is like $2 or $3 grand if you count the if you reduce or if you deduct the tax benefits from that, your out-of-pocket cost is a couple grand, and you're given a gift of $254,000. All right.
Yeah. I think we should, you want to end things before you're done, so I think we should probably call this a night. I've never done anything like this, but I appreciate you coming out tonight. We have a sign-up list if you care on the back table. One column is if you want information about the Jackson Investor Group, which you're all part of the first meeting. The other column is if you want.
Am I a founder?
Sure. The other column is if you want, want to be added to Dave's maybe email list. So, thanks.
Cool. Thanks for having me.
Thank you.
Oh man. That's quite a bit of stuff, huh?
No, it's all technical. It's just CPA to tell you.